Oh, Andrew, would you like me to say a few words of welcome when they come in?
Well, I think they're on their way in now. Councillor Thacker and Councillor Kempsey has also appeared as well. So I think we're now all here. I can see Hannah, I can see Chris, I can see Natalie. Good afternoon, everyone.
Afternoon.
Hi.
Sorry, we're running a few minutes late. We're all just doing a bit of virtual assembling. So I think is somebody at your end, Chris, Natalie, happy to share the presentation?
Yeah, I'll share the document now. It's like
brilliant. Thank you, Natalie. So you keep us on the right page to match whoever's talking. And Hannah, are you going to go first?
I am.
I'll
yes.
let you go. So we've got up to 3 o'clock, Hannah.
Okay.
I'm sure the members will have lots of questions. I can help out looking for hands as they go up. If you maybe you want to take sort of the natural breaks in the presentation to pause for questions anyway, and we'll go from there if that's okay.
Absolutely. Yep. Yes, we'll expect lots of questions as usual. So firstly, good afternoon, everyone. It's nice to see you all again. We've got a fairly standard presentation here. So I was going to start by giving you a bit of an overview on the sort of real estate market and what we've been seeing happen and what we think may happen going forward. And then Chris and Natalie were going to talk you through the portfolio in a little bit more detail and what we've been doing. If okay, I just wanted to take one moment as well, just to acknowledge that since we last saw you as a group, we have been appointed by the Access Pool to run their UK direct real estate mandate and their global indirect real estate mandate, which we're thrilled about. And, you know, obviously that includes you in the wider pool, but, you know, hope strengthens our relationship going forward as well. So just wanted to acknowledge that at the beginning. So without further ado, though, I'll maybe go through, Natalie. Can everyone see this okay on their screen? On my screen, it's not showing.
I was just going to say, Hannah,
Yeah.
sorry. Yeah, it looks, I think it's not just me or you then.
Okay.
It doesn't look like it's quite the sort of the whole screen being shared or
Is
something.
it not? Right, okay, I have got it in full screen mode. I don't know if it's, apologies. If it's not working, is it still not working?
No.
Right, okay, hold on, let me try to do it differently.
Maybe stop sharing and share again, Natalie.
Yeah, apologies. Sorry, I did try. Stop sharing, here we go. Apologies. Get it going.
Maybe while Natalie's loading that, I can. Oh, there we go. Perfect, Natalie.
That's it.
Yeah,
that's it.
Yeah. Okay. So we've just put a team slide to remind everyone at the beginning, and there has been a change in the team during the course of the year. But key that Chris, Natalie, and I and Matt Beaver remain constant within the team, and have obviously between us worked on your mandate for a long time now. But Joe Russell has joined your team as assistant fund manager, supporting Natalie and Matt in running your mandate day to day. Maybe move on to the next slide, please, Natalie. No, that's all right. So I'm going to give a little bit of an update on the market and maybe just start with a slide. I'm going to focus more on the real estate market, but just a slide and a couple of comments on the sort of economic backdrop, which I suspect you will all be very familiar with and don't really need kind of my input on. But I guess, you know, the key thing that everyone's been focused on and talking about is inflation and the impact that's having on the economy, but also the sort of broader markets as we see them. So we do believe that inflation is finally on a downward path, and obviously we've had a few positive numbers now, inflation numbers coming through in the last few months. But what we have done in our more recent forecast, and as you can see on the graphs on this slide, so the one on the left-hand side is looking at our sort of predictions, or Oxford Economics predictions of inflation going forward, and then the impact on the bank rate on the right-hand side. And what we've showed you is how our forecast, or how that forecast from Oxford Economics has evolved, which is sort of the base case that we use when we then forecast the property markets. So you can see it's sort of inflation has been revised upwards over the sort of Q2, Q3, and then Q4 house view as we sit here today. So we've pushed back our expectations of when it returns to that sort of 2% Bank of England target. in terms of impact on interest rates, you know, interest rates remained unchanged in November, so staying at 5.25%. And I think while it's safe to say that while earlier in the autumn, perhaps when we all came back from the summer holidays, we thought there was probably at least another rate hike coming. I think as we sit here today, and I, you know, add a note of caution, of course that may change. We think that is looking less likely, and that potentially we are at the sort of peak of those interest rate hikes. However, given the recent data, we do think that interest rates will be held at the sort of higher than rate that we've been used to over the last 10 years for longer. And I think that's really important as we look forward and talk about the real estate markets. So higher for longer, but I think financial markets may be just starting to think, touch wood, dare I say it, there's some more certainty in that sort of terminal rate and where we're landing and then heading on a go forward basis. And I think similar across the economies across the world, but maybe we see the US and potentially the ECB bringing those rates down quicker than in the UK, where inflation has been a little bit stickier and more persistent. Okay. So this then kind of carrying on really from that inflation side, so those higher interest rates increasing the chances of recession, and you know, we have moderated our GDP forecasts going forward, so they look pretty muted over the coming years. You know, to date, economy has been relatively resilient, but that unemployment rate starting to tick up, and I think households starting to increasingly feel the effect of those higher interest rates, and we're starting to see that come through in the sort of real economy as we go forward. Then if we move to the real estate market, my first slide is looking at investment volumes, and I think this graph paints quite a stark picture as you look at it. So volumes, transaction volumes, their lowest level since 2009, so since the GFC. We think that trend will continue in Q4. I'd say that's what we're experiencing kind of on the ground and day to day. So liquidity has been very constrained. What I would say, and you know, we've broken the data down here, investment volumes by sector. The industrial sector has consistently been the most liquid of the sectors through this period, with residential, which, you know, the data isn't great on, but following a close second, liquidity more constrained in the retail and office sector. And I would say that's largely because the market investors are buying into the long-term fundamentals in those two sectors and are able to get some comfort around pricing. I think the other thing that we should note in the transaction market is I think there's a big difference in liquidity between those large lot sizes and the smaller lot sizes. So as you start to creep up over that sort of 50 million, where typically you have more, you know, you have buyers that are more reliant on debt, so it's not 100% equity funded, there has been even more constrained transaction volumes, whereas actually at that slightly lower sort of 50 million and below, and even more at 20 million and below, we've seen a little bit more liquidity, and that's because the type of buyer there is very different. So, you know, you do get high net worth individuals, family offices, little private property companies that actually are buying with equity and taking a very long-term view on the real estate market. So I'd say quite a difference in liquidity at the different lot sizes during this kind of prolonged period of muted transaction volumes. If I then, thank you, Natalie, ahead of me. So this slide is looking at kind of month-on-month capital value movements. I say movements, but largely declines, as you can see. So we've got it taking it from left to right at the all property level on the far left as the slide as you look at it, and then broken down by the different subsectors. We have seen differences in the different sectors over the last sort of 12 to 18 months. And when I start to talk about the look forward, I think the key point I'll make there is that we expect the dispersion between sectors to remain wide. So we do expect very different performance as a generalisation between the different subsectors within the real estate market on a go-forward basis. And Natalie and Chris can bring to life that we think your portfolio on that basis is well positioned on a go-forward basis. But as we look at these monthly movements, I'd say capital values remain under pressure. We are expecting at a market level further outward yield shift in Q4. Again, I think there will be differences between sector and differences asset by asset. It's hard, as you know, to make sweeping generalizations when it comes to real estate, as each asset is unique. But we, you know, the logistics sector, when we spoke to a year ago, really suffered that big fall in Q4 2022 and was really a victim of its own success in that it was the one sector where there was liquidity, where there were buyers. So there were transactions which proved pricing levels and moved the valuations in the industrial sector ahead of all of the other sectors. But actually, it's the sector where we've seen stabilisation happen more quickly. And dare I say it, during the course of this year, there's been pockets of yield compression within the industrial sector. I would say by and large, particularly for Southeast industrials or supply constrained industrials, probably a fairly stable outlook in terms of yields. Maybe some marginal outward yield movement, but I think relatively stable as we sit here today. And then residential has been the other more resilient sector. And again, really there, it's those long-term supply demand imbalance and that investor appetite that's helping to hold capital values there, and very strong rental growth seen within that sector. And then the laggards relatively have been the retail and office sector. I think more outward yield movements come there. I think potentially interesting buying opportunities, and we've been taking advantage of some of that for you in the retail sector. As you all know, sector we've talked about a lot over the last 10 years. It has undergone a big structural transformation, but I think there now we've seen rents rebased, yields had moved out over the last 10 years, not really compressed in the same way as they had in the other sectors. And I think a little bit more certainty returning to that subsector. I think some maybe a little bit of outward yield movement in some parts, but I think starting to see some stability in some retail parks, elements of the supermarket sector, again, very asset dependent, but offering a sort of higher income yield. And I think for the right asset, you can invest in a sort of stable cash flow. The office sector is where we see the most headwinds, I guess, as a consequence, also some of the most opportunity. I think it's definitely the sector that's out of favour. It is undergoing structural change in you know, for different reasons, but in the same way as the retail sector did. It's been accelerated by COVID-19 and some of the changes there. So, you know, I think, you know, particularly that working from home, but also what's hitting that sector hard is the capital expenditure that's required to meet some of the sort of sustainability requirements going forwards. And we can come back to the office sector. I think, you know, I think it will be a story of the best and the rest in the office sector. So, you know, for the right buildings in the right location, we are still seeing tenant demand, and I think they will be relatively resilient. But I think there's a big tail within that office sector that will continue to see further valuation falls as we go forward. If we then move to be a little bit more forward looking and look at the next slide, which is looking at our sort of forward looking returns. Natalie, if you could maybe move us on one.
Yeah, it was. Is this not moving? Apologies.
No, I think you've frozen.
Brilliant.
Okay, so I can maybe talk to it. It's a testament to our Wi-Fi in the office, isn't it? That so apologies, but the next slide, slide 11, if you have it in front of you in your packs, is our sort of forecast returns going forward. These are at Q3. We're currently in the process of doing the Q4 returns. At an all property level, I had meetings on this earlier in the week. The return looks remarkably similar, I would say. So forecasting sort of Q1 24 forward on a 5-year basis. But I'd say there will be even bigger dispersion in the sectors in the new round of forecasts. So I think those office forecasts will by and large come back. I think important to highlight here that we're forecasting the prime part of the market. And again, there will be opportunity, but in terms of hierarchy, that logistics, industrial sector leading the way, with residential as a sort of close second. Sorry, was that a question? No, sounded like someone. Okay, I'll carry on. And then with the office sector being the laggard, but again in the retail sector, some pockets of opportunity, and most of that return being driven by the income return. And I think important to say that this is the bedrock of our forecast going forward. So, you know, the returns going forward really being driven by that higher income return, very little yield compression factored into our forecasts on a go forward basis. Slide 12, so my final two slides then really looks at our preferred strategies. Again, I think, yeah, there we go. So sort of articulating what I was saying. So, you know, preference for that sort of industrial sector, residential sector for those structural growth reasons. But also I think important to, you know, potentially be alert to taking advantage of market dislocation. So, you know, there are some motivated sellers out there. Those opportunities will come across all sectors, and, you know, you are in a great position to exploit that pricing as we go forward into 2024. And the team will pick up on it. I think, again, we've, you know, remained disciplined with the equity we have available for you in kind of buying opportunities over the course of the last 12 to 24 months. And then my final slide, I've really sort of just summarising all that I've said really. Economic growth starts to look more positive at the back end of next year. More certainty over that bank terminal rate. Investment activity has slowed. You know, liquidity has been fairly weak, but I think we expect that to pick up as we go forward into 2024. Outperformance will be driven by income growth, and Natalie will pick this up, but your portfolio looks well positioned, very low void rate, and as you know, we continue to focus on that. And are using this time, you know, it's particularly important that we're engaging with our tenants, understanding what's going on with their businesses, where the risks are in the portfolio. But to date, we have seen fairly limited impact on the occupier market. So I'd say they're a bit slower, but we haven't seen massive impact yet. But we may remain very alert to that as we go forward. I will pause there because I can see a few hands up, and I don't know whether there was something in the comments box.
Yeah,
Councillor Crawford with a hand up.
yeah, sure. Thanks very much, Hannah. I particularly noted under the housing residential, the way that you were giving priority to seemed to be giving priority to single person accommodation, student accommodation, and so on. I have to say, in the area where I am, which is in northeast Hampshire, there is a huge demand for 3-bedroom family accommodation, which is simply not being met.
Yep.
And I don't know how, you know, once it gets hold in the market that, you know, the money's to be made in single person student accommodation, that just seems to take over. Whereas actually in our area, this is where the big demand is. It's become so bad that we are now in our area, we've got, you know, in a population of 100,000, we've got 1,600 households on the waiting list, waiting for 3-bedroom houses. So
completely aligned with you actually, and we don't have a forecast for single family housing. It's not, we don't have enough data to do that. I think if you looked at the residential sector and looked at our preferred strategies, we would prefer single family housing over the kind of build to rent apartment blocks that I think you're talking about, for a few reasons. One, I think as a population, the UK are house dwellers rather than apartment dwellers, particularly outside of the big cities. So I think, you know, that is culturally what we prefer. Now that does differ in other markets. I think also from an investment perspective, there's a lot greater risk in that sort of tower residential landscape. So you know, the sort of fire eggs that we've seen, dual staircase coming in, etc. So actually, if you look at your investment in the Affordable Housing Fund in here, large proportion of that is actually single family housing, and we've actually just signed a framework agreement there with a house builder where we have priority on their development pipeline, which is all single family housing. So the problem with single family housing for institutional investors has actually been trying to access it at scale. But we think we have unlocked that now, and it is our preferred form of investment in the residential sector. So completely aligned with your view.
Oh, that's good news. Thank you.
Okay. Judith, I think Judith.
Just to pick up on that point, when you say family housing is your priority, are you working with registered social landlords or local authorities so that some of those can be affordable? Because it's a very good return on social housing. And sometimes investors investing long-term in a long-term income, pretty sure income stream is a very sound thing to do, as well as paying back on any capital loans you've taken out or profit you want to make on sales.
We absolutely are. So in the affordable housing fund that you're invested in, it is only doing that. So we work with registered housing associations, so social housing providers and local authorities. So that is 100% what we're doing. Where we like single family housing out of, I would say, the affordable housing with a capital A, the regulated sector, is that we like the affordable housing with a small a. So that housing that is providing affordable housing to middle income households, which I think are also overlooked. So again, I think completely aligned with that viewpoint, and that is where we are investing and focusing as a house and on behalf of you.
Good. I think that's important, and I accept the proper distinction you've made between the so-called affordable housing and social housing, which is genuinely affordable. And I think probably a mixture of the both is a good idea, because they have a different risk profile, of course.
Absolutely.
In terms of long-term lead and the balance between income and capital.
Yeah.
Thank you.
And the other thing I'd say in terms of sustainability, which is a first, the framework agreement that we've signed with one of the largest house builders in the UK doesn't permit gas boilers to be fitted in any of these new developments. So they will all be fitted with air source heat pumps. So sort of market leading in terms of sustainability. Also, I think really important in terms of...
Are we investing in...
What?
No, go on, you go on.
No, I was just to say, also really important in terms of running costs for those residents, which, you know, rent is one part, but also you've then got to run that home, heat it, you know, provide a pleasant environment actually for these families to live in.
Yes, thank you. Just going on with that question, and I'll stop then, is to say, are we investing in the larger housing associations that are the largest RSLs that are actually building homes for people in need in Hampshire, which will then have an effect on a positive knock-on the Hampshire economy?
Yeah, so with the Affordable Housing Fund, I'd have to come back to you in terms of whether, I know we have developments in Wiltshire. I don't know on Hampshire, actually. I'm trying to wrap my brains, but can I come back to you on that? I can easily find that out. And
yes, I mean, as pointed out already, in the north of Hampshire, there is huge demand on waiting lists, but also the same goes for Portsmouth and Southampton and the Solent area. And our local economy would be greatly improved if we didn't have so many people relying in homeless accommodation, or indeed being paid housing benefit for very expensive, insecure, sometimes low quality private rented accommodation.
Absolutely.
So if you could come back, that would be great.
I will.
Thank you.
We can come back, Natalie. We can make a note of that. I mean, sadly, you're not alone in terms of that problem and dire need.
Still for
but we
about
are concerned
30
about
seconds.
Hampshire people.
Oh no, of course, yeah. Shall I pass to Chris, unless there's, I mean, I can take questions later anyway, but Chris.
Yeah. Okay, thank you, Hannah. So just moving on from kind of Hannah covering the macro picture and the forecast for property, just feeding through to your portfolio. So this shows a snapshot of the portfolio. The figures are taken as at September, so the most recent valuation date. So you'll note capital value of 761 million, including purchases in hand and commitment. And that's a little over 200 million off the target size. And as we can come on to talk about, we've made good progress over the course of the back end of this year, trying to really capture market conditions at the same time as being, incredibly patient, because we are in a strong position with the capital that we have to deploy. And as Hannah's covered, we are working in a backdrop that, whilst market pricing has corrected or valuations have come off significantly, those transaction volumes are much more subdued than we've seen in the recent past. The portfolio itself remains very well diversified in terms of number of properties, number of tenancies. And as you'll see, if we look at the sector and geographic breakdown. We feel it's well structured to actually continue to perform well. And we'll come on to performance in a moment. But you will have noted when Hannah presented, she touched on the total returns forecast from property for the next 5 years. And one of the key outliers in terms of performing very strongly versus the other sectors is the industrial sector. As a team, we feel your portfolio is well structured in that regard. You have a healthy weighting to the sector, which is a good position to be in at this point in time. And as a secondary point, you have a very decent exposure to London and the southeast. And that is primarily made up of well-located southeast industrial estates with good prospects for rental growth. And as Hannah also touched on, if we look at the occupier markets, they've actually been incredibly resilient to date. The industrial market in particular, if we look at it, because of what's happened on the financing side of things and equity drying up in the short term, that has actually constrained supply. So we're still of the opinion that actually for the right industrial properties that actually offer rebased valuation, the prospects remain strong, and your portfolio in particular has a very good exposure to those types of properties. And then the other point just to draw out, and there's the average lot size at 15.5 million. As you'll be well aware, your portfolio has grown incrementally in size over the years. And correspondingly, we've tried to increase the asset size. So with the equity, with the capital we have to deploy, we are looking to increase that. And as Natalie comes on to talk about some of the example transactions, highlight that point. But one of the great things is because the portfolio is well balanced and structured going forward, we have a degree of flexibility as to the sectors we can target to invest that money. So thanks for that, Natalie. We could just move on to performance. So this shows the performance of the portfolio over various timeframes. And just as a reminder, the target is to achieve a real return of 3.5% per annum over the longer term. So that's 7 to 10 years. And one of the things that you'll be well aware of is actually inflation has been rampant in recent times. And what that's done to real returns across the board, not just relevant to your portfolio, it has made that target much more challenging to achieve, actually, even over the medium term. That coupled with a pricing correction means that actually over the short term, it's also been more challenging. If we look over the longer term, actually, despite that, the portfolio isn't too far off that target return. And the reason for the line not being completely flat in terms of the target line is because that target changed in 2018. But the key messages here really is just to draw out is your portfolio returns are depicted by the bars. The line, as I've covered, is the target, but we've also, as a secondary reference point, included these triangles. And it's important to do that because they represent the market return. And what you'll hopefully note from this is actually the portfolio has exceeded the market return, so the MSCI return over all timeframes. So over the shorter term, but also over the medium and longer term. The other kind of final point I would make here is whilst it has become more challenging to meet that real return target when we look backwards, with the capital that we have to deploy in this repriced market, we are actually able to identify new acquisitions where we feel comfortable, even with very cautious underwriting, that the go forward returns should exceed that target quite comfortably. So we're kind of in this middle ground position, but we do feel that the portfolio also in aggregate is well structured to exceed it from here on in off these rebased valuations. So unless there are any questions on that side, just moving on to the next one. Thank you, Natalie. So it's going to touch on portfolio transactions now, and I've got a couple of slides here, high level picture before I hand over to Natalie. I won't spend too long on this one actually, because it covers some of the points that as a team we've already mentioned, but the target size is 965 million. So we have 200 million to deploy at this point in time, which is a very advantageous position to be in the context of capital markets more broadly. And I think our anticipation of more stock coming next year. We've put 12 to 18 months to deploy the remaining capital. I think that will really be determined by what happens in terms of the supply of stock as opportunities do present themselves. We are aware that there are a number of funds with DB schemes in them that have had redemptions where those have been deferred. So we do envisage that pipeline of sales coming through more meaningfully next year, obviously starting from a low base. And the same can be said about the on the debt side of things, actually, we are starting to see it a bit more in terms of distressed selling than we've seen throughout the rest of the year. But as we highlight here, really targeting slightly larger lot sizes than we have in the portfolio at present, with a degree of flexibility, so 20 to 70 million. But we want to end up having a portfolio that remains pretty well diversified in terms of properties and tenancies. And then we just put in one additional slide in here before I hand over to Natalie, which highlights net investment. And the reason that we wanted to put this in and draw it to your attention is obviously we have looked after your portfolio for quite a long time. And what it shows is the net investment, both purchases and sales, every year since the onset of our mandate, plotted against the portfolio's net initial yields as a proxy for how expensive the market is at that point in time. And really what I'd like to draw out here is that in the early years of our mandate, when the net initial yield was high and arguably the market was relatively cheap and the returns from property are attractive, we tried to invest quite quickly. And more recently, as that pricing has moved, those yields have moved out and those prices have reduced, we again have looked to invest more heavily. And an important point to note here is actually this shows the amount invested in absolute terms, whereas if we plot the same graph and we show it as a percentage of portfolio value or target size, it really highlights the point even more dramatically, i.e. we've invested a lot when the market is relatively cheap earlier on as a proportion of portfolio value, and the same can be said as at today. So unless there are any questions on those few slides, I'll hand you over to Natalie.
Okay. Please shout if you can't see any of my slides while I'm talking as well, because it doesn't quite show everything correctly. But I suppose these are what I'm going to cover, some of the transactions that we've bought and are under offer for the portfolio to begin with. So the first one that was purchased this year was in September, Templars Retail Park in Oxford, which we bought for 53.2 million, which is a net initial yield of 6.3%. So really referring back to the high level points that Hannah touched on and certain assets and why we like them. This is a retail park with a sustainable income stream. So you can see the diversified tenant lineup. It's just shown in the bottom with all the different retailers that are on the park on that picture. So we like it where tenants provide necessity, convenience, and discounted elements. And also back to the point that both Hannah and Chris touched on with market dislocation. We had a motivated seller here. They needed to sell. So we were able to purchase this at rebased pricing. Why we liked this particular asset and Oxford in particular, it's an affluent city. The supply of retail warehousing was getting constrained or is continuing to get constrained. So the provision of other retail parks elsewhere in the city is set to be greatly reduced as they go about applications through change of use. It is a fully let scheme, as you will see. 45% of the income, 44% of the income was inflation linked. And there are immediate short-term asset management opportunities for us. So we already have a lease regear in legals with Pets at Home. We are talking to JD Sports about renewal on their unit. And there is increased tenant demand, having seen tenants being dislocated from other retail warehousing schemes in Oxford. The next asset that I'll come on to talk to is Berners Mews, which is in Fitzrovia. So a small office in Fitzrovia in London. This is the acquisition of an adjoining ownership. So at the end of 2021, we acquired for the pension fund an asset on Newman Street. So we already own the freehold of this particular asset. But the intention here is to amalgamate the two buildings. So they were previously combined. It was previously a school. We already have planning to extend the existing ownership. And what we can do here is commence works sort of mid to late 2024 here and create basically the type of offices that we see as what we want going forward. So creating the type of assets we want to hold long term. So why we like it, it fits our office strategy. So it's located just off Oxford Street beside the extended Tottenham Court Road station. It is in a great micro location, but it's also on a quiet street, so great for office users. But as I mentioned, we create this building that we want to own longer term with enhanced ESG. So enhanced EPC rating, BREEAM outstanding ratings, zero emissions. We will have things like roof terraces, end of trip facilities for tenants, and basically the type of office where office occupiers want to occupy. Moving on, another office acquisition. We exchanged on this acquisition earlier this year, so it's set to complete later this year or early next year. But the vendor still has a number of items they have to deliver. So again, a recap on this: it's a brand new, best-in-class office in central in the central business district in Bristol. Has all the fundamentals of offices that we really like. So good natural light, good floor to ceiling heights, and again, crucially, very strong ESG rating. So very strong ESG features. So again, a BREEAM outstanding rating, EPCA. It is let to very strong covenants, the likes of Osborne Clarke and Deloitte. And since we exchanged, we have already let additional space within the building at higher rental levels than we actually underwrote the acquisition at on our initial appraisals.
Natalie, I think there's a question.
Sorry.
Councillor Crawford, was it?
Yeah.
I think a hand up.
Yeah, sure. And actually, it wasn't so much a question, more a comment on the situation with the BREEAM ratings both being outstanding on those buildings. I think that's excellent, because it's very hard to get to outstanding rating, and I think it's a big selling point. Yeah, thank you.
Yeah, agreed. It absolutely is. In fact, Halo is one of the, at the time of being launched for sale, it was certainly, it may have since changed, but it hasn't, as far as I'm aware. It was the only office building that has achieved an outstanding certification outside of London. So there were very few. Moving on to sales then.
Natalie, you've also got a question from Councillor Glenn.
Sorry.
It's a pretty basic one. Going back to Berners Mews in London, you mentioned that you're going to refurbish it, make it 2 buildings into one. I think that's the general thrust of this. Who pays for that?
That is from the pension fund money, so that would be capital expenditure used from the available funds for investment.
Got it.
So when, just to explain though, when this went to investment committee for approval to buy the adjoining building, the team had to lay out the capital expenditure required and the sort of detailed project. Obviously, we would still need to go to tender and get all of that done, but that is taken into consideration when the team acquired the adjoining ownership.
Okay, got it. Thank you.
Moving on to sales, I suppose important to always note
Natalie, I
that.
think there's another question.
Sorry.
Yeah, a very quick one on Halo.
Yeah.
Councillor Joy here. Can you explain the significance of the unexpired lease term of being what seems to me a short period, 11 years, please?
Yeah, I'll jump in, and Hannah and Chris jump in if you want to add to it. I would actually say in offices, generally office tenants at the moment are probably taking more on average of about 5-year lease terms with maybe 3-year breaks even. So actually, where Osborne Clarke have signed up for a 15-year term on this office, that's it certainly used to be a historic. Lease terms have in recent years just continued to go down, where occupiers have wanted to remain flexible. So their commitment with what is actually quite a long term here for, I would argue, is a very strong point for an asset like this.
Yeah, and I'd echo Natalie's comments there. So 11 years in the office sector is quite unusual. So as she said, typically 5-year leases with a break at 3. So, you know, this is at the long end for offices.
Right, but is there vulnerability sort of associated with that?
I mean, in this case, you'd argue that, I mean, you know, actually you've got good covenants in the building. So the vulnerability would be if you had an 11-year term, but to a covenant that was an organisation that financially was very, for want of a better term, flaky. And so you're at risk of them kind of going pop. And then really, what does an 11-year, well, 11-year, you know, the lease means nothing, a 15-year lease. So, you know, there's more value in a lease that is long, to a sort of more financially secure tenant as well.
I think for
Thanks
office,
very
it might
much.
be,
I'm familiar with flaking.
the other thing might be just for offices, capital expenditure has gone up greatly. So with a building such as this, a lease expiry doesn't pose the same threat that it could do with an older asset that requires significant expenditure. So yeah, it's longer than the average, and that's a good thing. And we'll get the rental growth through rent reviews. But should any of the tenants leave, I think it will present an opportunity for further rental growth.
Fair point. Thank you.
So yeah, I suppose moving on again, jump in if I've missed any other questions, but moving on to sales, I suppose keeping one eye constantly on the existing portfolio and looking at forecasted returns of the existing assets within the remainder of the portfolio. These are generally, well, these were all assets that were forecast to underperform going forward. You will note the average lot size is generally smaller, so the impact that they have on the portfolio has been less. There are 2 completed assets on the slide, so Exeter and Romford. One is currently under offer, which is Kettering Leisure Park. The whole leisure industry had changed with COVID and the introduction of streaming services like Netflix. So it had a huge impact on cinemas. So the performance from that asset was weaker, but as it was income producing throughout, it actually had a very negligible impact at a portfolio level. We are marketing 2 assets. You'll see there, East Grinstead and Belfast. On Belfast, we actually have offers, and it's just gone under offer at 7.5 million, so ahead of the valuation on that. And East Grinstead, we are targeting. We are still negotiating with some potential purchasers on that asset. I'll move on if there's not questions. On to income. So what we
Actually, I think you have a question.
I think.
Sorry.
Yeah, I mean, not entirely relevant, but just out of interest, are those making a profit, those sales, or otherwise?
So I suppose it varies, and I suppose it's worth noting that so where some of the assets have been acquired for larger sums of money, there's also an income return that has been generated throughout the life cycle of them. So for the example, Kettering that I mentioned just now was acquired for 12.4 million, but it has been income producing almost 100. Well, it's been largely income producing throughout the throughout the whole period. So not everything is being sold for more than it was acquired for, no. But I suppose it's in terms of a total return, they are still in some instances accretive or negligible in terms of the returns.
Simplistically, the longer you've held an asset for, the more important the income return becomes as a proportion of the total return, and actually correspondingly, the less of an impact the capital value movement. So like Natalie said, this is a mixed bag, but generally they've had high income returns. And as another point, in the context of the portfolio, they're quite small properties, so their weighted contribution is limited as a function of that.
I think
Yeah.
also I'd say we don't always get it perfectly right. We don't. And I think we do the majority of the time, and that plays out at a portfolio level. I think we also have to adapt the portfolio to changing requirements within the market, and importantly what tenants are demanding. I think in some of these sectors here, those changes have been massively accelerated by the sort of COVID, what went on and what we've seen. So I think we also try to look forward, and even if that price doesn't align with what you purchased it, importantly is this going to get better? Is there an improvement? Is there something we can do to it to make it better, to ensure that we get best value? Or is exiting now best value for you? So yeah, that has to be in our minds and central to how we think about these.
Yeah. I mean, I understand, it's better to cut losses and run profits, but clearly, a £9 million loss on Kettering Leisure Park, you need a lot of income to make up for that. The other one I suspect you might have taken a loss on is Exeter High Street, because that's a fairly run down bit of Exeter, isn't it?
Yeah, I don't have, oh, sorry.
No, go on, Natalie.
I was just gonna say, I don't have the numbers off the top of my head, but actually, there was a big renewal done with McDonald's and it was sold well ahead of what the valuation was at the time. And I would argue that I suppose we actually exited at the strongest time occupationally that we could have done, having done the re-gears with the different tenants that were there. And the type of purchases that we're looking at creating some residential above and things like that. So I mean, I suppose we also look at those, like Hannah said, the forecast returns for it. And in terms of what we forecasted in terms of performance coming forward, it was absolutely the right time to dispose of that asset.
No, that's the point. I mean, I thoroughly accept that. And to upgrade the portfolio may involve taking losses. It's just I was trying to get a hold of the quantum of the losses, which gives us a flavour of the market today. That's all.
I think what we could do going forward to address that is in this table, maybe we put purchase price and IRR over hold period, Natalie, and we can then talk that. So I think there's no reason not to have an open conversation about that. So why don't we include that in the interest of transparency going forward?
Sure. I was going to say over the 10-year term of Kettering, the weighted performance attribution to it was minus 0.01%. So it was basically it neither enhanced performance nor detracted from performance. So I appreciate the comment about what seems like quite a big capital value loss, but actually when you compare it, when you put it in the whole portfolio context as well, it doesn't have as big an impact.
But we'll amend the slide going forward.
Yeah, we can provide those weighted numbers.
If I move on to income, and conscious of time, so please tell me if you want me to rattle through it at a bit of a quicker pace. So what we're showing on this slide is how we focus on our client relationship managers, so our CRM role, and this is engaging with our top tenants across all of the sectors. And why we do this is really because because income is such a big focus. So we have a proactive approach with discussing with tenants, which feeds into our tenant data. So allowing us to deliver those lease renewals and again, ensure sustainable income streams that we have spoken about a lot. If I move on to the portfolio, so you will see that portfolio vacancy rate is 3.1% versus the market, which is at 8.3% as at September. The 11 years average unexpired lease term has been growing and is in a good position. We've over 2023 secured 7 new lettings and 5 lease renewals, with a further 4 under offer. So 12 transactions completed and 4 more ongoing. I'm going to keep going and just delve into that vacancy rate, but jump in if anyone had any questions as I go, please. So the vacancy rate is at 3.1% as at September, but it's worth noting that's already down following that quarter date at 1.9%, which is the lowest that it has been certainly in the last 5 years, and much lower than the market at 8.3%. So really focusing on letting up vacant space and keeping that vacancy rate as low as we possibly can. This is a slide that you will have seen a lot. Again, so a well-diversified lease expiry portfolio. So focusing on the low void and extending those leases early where appropriate. So we have a dotted line there at 10%, which is where we try to ensure that not too much income expires in any one year. But you'll see also that the majority over the next 5 years of that income that is expiring is in the purple colour, which is in the industrial sector, where we have actually seen very strong rental growth. And an example of that I'll come on to on the next slide, actually, which is a case study of one of the assets within the portfolio. And it's worth noting as well, when we talk about new acquisitions, we're still considering income with longer income with that capital to deploy. I think there's a question. No.
Yeah, there is a question.
Sorry.
Yes.
Sorry, yeah. Are you coming on to rent arrears?
We haven't actually got a slide on it in this deck, but we can discuss.
I mean,
Well,
Natalie, the reason we don't have a slide is that we are in a more normal position. So we do report rent arrears and kind of rent collection in our quarterly reports to you as a group. And obviously during COVID, when we were granting rent concessions and kind of big arrears were sort of clocking up, we obviously, you know, did include it then. I think as we've moved to a more normal environment, Natalie, it's fair to say that we kind of took that slide out and see it as more normal course business.
Well, what you might call normal, perhaps not all of us would agree, because we have other experiences. But, you know, let that rest for a moment. It's really just to emphasise the fact that in terms of cash flow to the pension fund, it's this property portfolio is the main investment contributor. So it's very important to us. And in the past, I have been concerned when arrears were sort of running at about something like 8%. Now, I agree, you know, you measure it over time. And as, you know, time scales narrow, so the rent arrears improve. But it is a very vital slide. And I do think that you ought to include it in future with respect.
That's absolutely fine. I mean, we include it as standard in our quarterly reporting to you anyway, so it's absolutely fine.
Yeah, we can include, it makes sense to those aggregated numbers for previous quarters reporting. We can include that in the presentation next time. But as Hannah said, the position is much, you know, much improved after COVID. Some pretty high collection rates, but obviously we don't have that in the deck, so we can we can follow up on that.
Shall I go on? I was we've got here an asset sort of a case study, as it were, so an asset management initiative that was carried out on one of the industrial estates from the portfolio in Chessington, so Silverglade Business Park. So this is just a typical example of what we do. So at the start of 2023, we completed a lease renewal at £15 per square foot on Unit 9. We then had 2 vacant units, so Unit 2 and 10. So we refurbished those vacant units, which included ESG improvements, so stripping out the gas from the unit, moving the EPC from a C rating to an A rating, and actually installing solar PVs, and therefore moved on the rent from what was £15 from earlier in the year to £16.65. So percentage-wise, a big increase. And now other tenants on the estate are also looking for similar ESG improvements and refurbishments, extensions to their own buildings and solar PVs on their roofs. So we are discussing with some of the existing tenants in order to keep them, in order to retain them on the estate and improve the rental tone. And also there will be a unit coming back vacant, Unit 4 in 2024, and similarly our plan there is to refurbish that unit and improve it again and move on the rents potentially even further still. I'll touch on ESG. I am conscious of time, so please.
I think there's another question,
sorry.
Natalie. Yeah.
Councillor Crawford, do you want to go?
Okay, thank you. I got confused switching between screens because I couldn't see the slide on this screen, but I can see people on this screen. But anyway, the question I had was in terms of this solar PV, and what I've noticed is that these buildings, you say you have it on the roofs, but sometimes these buildings are in quite big estates, quite big pieces of land. Isn't there the opportunity to use other parts of the land also to enhance the contribution of low carbon energy towards the site? It's just it seems to me it's something that all the attention is saying we can put it on the roof, but it may be that even in other properties, you may have opportunities where the building may not be suitable to have it on the roof, but it may be that in the grounds around the property there are opportunities there. I don't know. Is that something that you would study? Sorry.
So for industrial assets, typically that area falls in the demise, and the circulation for vehicles on site is very important. But one of the things we do, just generally think about ESG, is we do look at EV charging points where we can actually install those across properties, across sectors. So that's another win in terms of, well, from an environmental perspective. So if there is excess land, perhaps that's something that we could look at, but that would be a rare occurrence, because normally, certainly for southeast industrial sites, the site cover is quite high because the land values are high, and as a result of that, the tenants really require that yard area is an important part of their operational business.
Right. Okay. Thank you very much. Thank you.
Chris, Natalie, I am very conscious of where we got to with time, and it does feel unfortunately an hour has flown by. So are you sort of able to?
Do you want me just to? I mean, I'm not belittling it, but should I just let Chris wrap up in terms of a conclusion that the ESG and skip through the ESG couple of slides? Would that be appropriate?
I think hopefully members have seen the presentation and hopefully have a sense of it, and maybe we take this away and when we're thinking about next time, if I can remember for 12 months time, that we think about the order so that we, don't leave the same things to the end of the presentation if time is rushed next time. So yeah, I think I'm happy with that. Thanks, Natalie.
Sure.
Okay, thanks, Andrew. Thanks, Natalie. I mean, just in summary, really, just covering what we said, and Hannah obviously presented at the start that we remain in a situation where there is certainly economic headwinds and some uncertainty and differing views over the terminal bank rate, but the positive there is that inflation does seem to be coming under control. From a property market perspective, there is the risk of further valuation falls, albeit we feel that we've seen the significant correction, if you like, that has occurred. The UK market, the pricing has come off pretty dramatically versus some other markets. And we're in a position now, when we think about your portfolio, and that we feel it is well diversified, structured well across the sectors to actually benefit on a relative return perspective going forward. And actually, Natalie and Matt and Jerv worked very hard to bring that vacancy rate as low as possible, so driving that income. And we're really mindful now of just making sure we make prudent decisions with that capital that we have. We still have to invest in this market in the expectation, if you like, that there'll be more stock coming through next year. And yeah, we've covered ESG. Clearly, it's very important for us as a business. It's very important to you as a client. And the nice position we're in at the moment is there is clearer kind of match up, if you like, between those aspirations, but also the likely returns of assets going forward. And we're really factoring that all into our decision making. So that was it. I don't know if Hannah or Natalie has anything extra to add on that, or any more questions. No.
I just wanted to say a very quick word of thanks, actually, from all of us. It was a really, really good presentation. And as you rightly say, the vacancy rate is impressive. So thank you very much indeed. Good luck over the next 12 months, and we'll look forward to seeing you later.
Thank you. Thanks for your time.
Happy Christmas to you all.
Cheers. Thanks, everyone.
Bye.
Right, I think CBRE have left us, and I think we've got GCM now joining us. I can see Florence, I can see Ravi, I can see Fred, and I think John should be there somewhere, which means it's good afternoon and good morning, I think.
I was just waiting for you to say my name for me to pop up.
Very, very good timing, John. So yeah, so members, a range of colleagues from GCM, which we're very pleased to see, and we appreciate all their time. I'm not sure we've got all of them for the whole hour, but I think they'll explain that as they pick up their various parts of the presentation. So GCM managing our infrastructure portfolio and have been for some time, since 2016. Florence, are you okay to share the slides?
Absolutely, Andrew. Whenever you're ready, I'll share the slides.
So I think we'll try and maximize all the time we've got, and let you guys get cracking.
Brilliant. Thank you so much, Andrew, for the introduction. I'm pretty sure that everyone in this group is familiar with the group from GCM, but for those who perhaps aren't, we have John Levin, who is our president, on the call. And Andrew, as you mentioned, John will have to leave after 20 to 30 minutes, if that's okay. We also have Fred Pollock, who is our CIO, and Ravi Parekh, who's managing director of our infrastructure business. In the interest of time, as you said, Andrew, I'll pass immediately over to John. John will give you an overview of the business and update of the firm. He'll then pass over to Fred, who'll perhaps give you a bit more of a macro overview across asset classes, and then Ravi will dig deep into the portfolio and perhaps a little bit on the macro environment in relation to the portfolio and its performance. Does that sound all right, or is there anything else we should be covering?
Sounds perfect, thank you.
Brilliant. So John, I'll pass over to you. I perhaps won't share the screen so everyone can see John. And then when we dive into Ravi and Fred's part, I'll start sharing the slides, if that's okay.
Great. Thank you, Florence.
Brilliant.
And thank you all for being on the call today. It's nice to see you again. I think we probably did something similar at roughly the same time last year. And we appreciate the partnership and appreciate the relationship that we have with all of you, and pleased to spend the time with you today and certainly answer, please interrupt and ask any questions you have. I would say that I think the most important thing from my perspective, starting from a firm perspective, is that we have managed what has been a very challenging environment very well. And I think that we don't take that for granted. We don't rest on our laurels. But when I think about what's important to our business, the most important ingredient is our people. We are a human capital business. We are effective at what we do because of how we invest capital, how we work with our client relationships, and how we execute generally in the marketplace. And it's been a particularly difficult period of time, in my opinion, from a human capital perspective. Everything from COVID and the pandemic, and then the return to work, to inflation, to geopolitical risk, to higher interest rates, to a tight labor market, and the list goes on. It's been a very challenging environment to manage human capital. And it's when our culture and when our business is tested most is during those periods of time. And when I look at what we've been able to accomplish during that period of time in terms of the retention of our people, the acquisition of new talent, that's been a very proud success for our firm. Now, obviously, why that matters is what it translates into. And it's translated into protecting capital for our clients, making money through these difficult markets. And you've experienced that in your infrastructure relationship with us, and the ability to grow the business. And growing the business is important. Growing the business is important because we believe that scale gives us even greater opportunities to effectively deploy capital on behalf of our clients. Growing the business is important because economic opportunity and career opportunity is important for that most critical asset I talked about in the beginning, which is our human capital. And I think there's no better representation of our ability to execute on our business plan, to really nourish the talent that we have, and to grow the business than in our infrastructure platform. And that's a credit to obviously Fred's leadership of the investment team, Ravi, and the rest of the infrastructure leadership team, and what they've been able to do. And frankly, when I look back, 7-8 years ago when we started our relationship with you, I think a lot of the success that we've been able to have in our infrastructure business looks to that relationship generically, or other relationships that we've started around that same period of time, as models of success in terms of how to deploy capital in the infrastructure space. Have a diversified approach, best-in-class fund managers, co-investments, secondary opportunities, do so in a flexible and opportunistic way so that you can take advantage of dislocations in the market and take advantage of the opportunities in the asset class. And it's really been a bright spot for the firm in terms of what we've been able to accomplish as a firm as a whole, has really been within our infrastructure practice. When I think about the business going forward, and when I think about what's going on in the world these days, I would say that certainly we're in a period of, and Fred will talk about this a little bit more, we're certainly in a period of transition. We're in a period of kind of regime change. When people talk about all the different factors that affect markets, and there are many of them, economic growth and geopolitical and all corporate actions and so on and so forth. In my own view, there's one factor that matters more than all the other ones, and that's interest rates. It's the most powerful factor, I think, that drives market behaviors. And we've been in a regime shift, in a serious, significant transition from an interest rate perspective over the past couple of years. And that always causes anxiety, it causes dislocation, it causes people to slow down and pause, it causes all sorts of behaviors that generally are not healthy for markets. And I personally believe we're at the end of that regime shift, or near the end of it. That doesn't mean interest rates are going to necessarily be lower. It doesn't mean they're not going to go a little bit higher. But the magnitude of going from effectively a zero interest rate world to a 5% interest rate world is massive as compared to whatever might happen next. And I think when you come out of that environment, it gives you, and you kind of feel like that transition period is nearing the end, you start to see a normal, more healthy functioning of markets. And certainly that's what we expect to see. That doesn't mean that we won't have a recession. It doesn't mean you won't have some volatility in the markets. But I think the period of time of really significant change seems to be, at least in the late cycles from our perspective. And that will mean, in our view, kind of just a normal functioning, a little bit more normal functioning of markets. And what do I mean by that? A little bit normal functioning in terms of people deploying capital or committing capital to the alternative space, a little bit normal cycle and environment for the deployment of capital into investment opportunities. And then probably even most importantly, a little bit more normal environment for the realization of investments, the exiting of investments, which is something that has really been slow across all different asset classes over the past couple of years. I would say that there are probably two areas of the alternatives market where we've, frankly, despite all this regime change and shift change, there's been less of an impact to what's going on, and that's been in infrastructure and in credit. And I think that there are lots of reasons for that. I think people like the risk return profile of infrastructure and credit. I think people like the cash flow dynamic that exists inside of infrastructure and credit. I think people like the idea of locking in some longer duration cash flows when you're in an environment like we're in. And I also think that part of it is just structural, meaning that those are two of the less mature asset classes within the alternative space. So people are still not at allocation. They're still building towards allocation, which is always a nice tailwind. And we've, as I mentioned before, we've been a beneficiary of that certainly from an infrastructure perspective. When I think about our goals for next year, when I think about our goals for the next few years, it really is a very, very, very boring answer. Keep doing what we're doing. We purposely have set up our business to be able to help clients, largely institutional investors around the world, build a part of, all of, a portion of, whatever it might be, of their alternatives program, to be able to do that in a best-in-class institutional way, to do that with great results from a risk-return perspective, great results from a client service and relationship perspective, and we want to be able to keep doing that. And so that's our kind of plan as we move forward, which for us always means making sure that we are taking care of the assets that we have and also constantly investing in the business. Investing in the business from a human capital perspective, and infrastructure is a great area of that. When I think back over the last several years in terms of how that practice has grown, in terms of the personnel involved in investing from a technological and operational perspective to make sure that we can keep up with all the customized reporting needs and all that of our clients. And so it's really hopefully a good answer, but a boring answer, which is to try to keep doing what we're doing. And so I'll pause there. Happy to answer any questions from a firm or anything perspective. Certainly, Florence, if there's anything you think I missed that's worth covering, happy to do that as well. And Fred and Robbie as well. But please.
Thank you, John. I can see that Councillor Crawford has raised his hand. Please go ahead with your question, Councillor.
Yeah, sure. I have a couple of questions. The first one was about interest rates. I was interested to hear what you said, that we're seem to be at the end of a period, whereas in the UK, what we're hearing in the UK is that interest rates are going to remain at their current level probably until autumn next year, which is that's perhaps different from in the United States.
That's actually a very good question, and I should be more clear in what I meant. When I say we're near the end of the period, that doesn't mean rates are going back down, because I don't know, and if I did know, we'd be all retired on a beach somewhere because we'd have perfect prediction of the markets. But what I mean by when I say near the end of the period, the end of the period when you're seeing change. So my view is one of the things that markets struggle with is they struggle with change and they struggle with periods of transition. If you told all market participants, hey, rates aren't going back down, but they're going to stay high and they're going to stay high for a while, people know how to deal with that. They can model that, they can predict that, they can wake up in the morning and expect that. The hardest period of time for anyone that has to manage capital and anyone that has to manage people inside of a capital market is when it's changing. And so when I say near the end of the period, what I mean is near the end of the period when you're seeing it go from zero to whatever level it's at now. That's the transitional period that I see being near the end of the cycle. That doesn't mean that I necessarily think rates are coming back down. I just mean the rate of change of interest rates is nearing the end of its change cycle. Does that answer your question?
Yeah, of course. Yeah. The other question I had was about the idea that you should keep doing what you're doing. I'm a bit concerned about the whole issue of climate change and its effect on infrastructure projects, because what we seem to be approaching is, certainly by the end of this decade, is the possibility that we'll be reaching tipping points in terms of climate, which would put a lot of infrastructure projects under pressure if they're not resilient enough to deal with those kinds of massive changes in the climate. So I don't know how you cope with that.
Yeah, I think that's a great point. It's a huge part of our investment underwriting, generally across the firm, but most specifically in infrastructure, just given the general connectivity often of infrastructure assets to the whole energy ecosystem. So a huge part of our underwriting, putting aside that we all believe there should be a cleaner world, we should invest more in clean energy, but and we probably have a shared viewpoint on that. But even putting that aside, simply from a risk return perspective, simply from understanding what you're underwriting and understanding the evolution of that investment over your holding period, which is going to be a very long time, you need to understand those climate risks. You need to understand how the asset that you are buying is going to be affected by that changing environment. And as far back as I can think of in terms, and I think we get better at it every year and better at it all the time, but I think that as far back as I can think of, that's been a critical part of our underwriting analysis to make sure that we understand those risks. And again, it's particularly true in infrastructure because of the types of assets you're buying, but it's also particularly true in infrastructure because of the duration of the assets you're buying. You have to think really long. You can't just think about what's going to happen in the next 3 years. You have to think about the next 10, 15, 20 years. And I don't know, Fred, if you want to add anything on to that question from the Chancellor.
Oh, I mean, I think it's like, I think you mentioned, well, at least in our system, we've been kind of conscious of these issues for, a decade plus. Like I would argue maybe we're late to the party. A decade plus probably is late, in terms of conscious, everyone, I'll tell you, all market participants at this point are conscious of it. Now they're kind of the spirit in which they come at it in the infrastructure world, I think, is just very different. Some people come at it in the spirit of this is an opportunity for kind of like positive change and acceleration of a trend. And some people are just worried about losing money, and they don't want to have stranded assets, and they could have it. And the good news, I think, actually, is that the consensus of most market participants now, they both get to the same right answer, which is you're putting more capital into things like energy transition projects and other types of things, and you're starving capital, or the cost of capital is much higher on the projects that kind of problematic. And so in a weird way, the market is probably having more influence on the topic than anybody's conversations having, if that makes, and that's probably the right thing. It's like the conversation was necessary to get the market to be aware of it and react and realize it was a major force. And the fact that that's how global allocators are thinking about their money is then have an influence on the market pricing. And that market pricing is starting to do the work that needs to happen. Is something we would tell you. And, Ravi will go through it in detail, but it's like half of our activity in the infrastructure space right now is something on the end of benefiting from the transition. You know, it's renewables, it's energy transition, it's where our activities, it's where the change is, it's where the opportunity is, and it's where you're having kind of an impact. So, you know, we'll talk that through, but you're not wrong. I mean, I think you're correct that there's this huge change happening and you need to, but it's more than consciousness. Like the whole market is almost there, at least with the money. Now, I know the rhetoric isn't there. Like if you turn on the television, at least in the US, you know, 50% of the people are arguing with the other 50% of the people whether the world's getting warmer, if you know what I mean. But the market has a consensus that it is, and the market is pricing the things that are relevant, like insurance, infrastructure, asset costs. You know, the market's pricing it all the way that I think you would think is logical. You know, if you were on the side of kind of looking at science and looking at what the changes and what the conditions are. So we'll go through some of that, but it's half our practice now. You know, it just is a good sense, like meaning you know, in terms of the activity.
Okay, thanks very much. That's reassuring. Thank you.
Maybe do you want me to pick up, John, with a little bit of maybe I'll fill out the macro piece very quickly. John covered a lot of this, just to maybe put a little data around what he was trying to say. John and I do a ton of these calls, and so what ends up happening is I steal his material and he stole half of mine. So now I've got no punchline, but it's okay.
That's why you got to go first.
Yeah, you got to go first. But what's I'll tell you what's odd. So if you looked at inflation break-evens, which is simply you take normal interest rates on debt and you subtract what the market is pricing on inflation-linked instruments. So meaning that, you know, what people are transacting at right now, they're pricing back at 2% in the United States. So the market has decided the inflation scare is over. If you look at that rate, I mean, it was 2% before we had the inflation scare. It got all the way up to 4%, meaning that's what the long-term pricing in inflation was for a period of time back in April 22, and we're all the way back to 2%. And you've seen a dramatic easing in financial conditions. So in November, the easing in the global financial conditions was the most in the record of the markets. So going back kind of 125 years, all the data. The November period we just had was the biggest easing ever in financial conditions. And they measure everything, you know, interest rates, equity markets, risk premia, everything. It was kind of best. And it was this pricing. I think that the interesting thing is inflation is not actually dead yet. And so like the inflation data is still running at 3.5% plus 4%. You still have short-term rates high as a policy response to that. But you've got the market kind of anticipating that inflation, you know, kind of the dragon has been slayed. We don't know. So what John said is completely right, meaning I think that's a little bit unknowable, but that's, you know, where the market is pricing it, if that makes sense, in terms of the market's got some degree of confidence in that. The other thing that I think is interesting is the market doesn't know whether we're going to have a recession or not. There's kind of this Goldilocks phenomenon priced into the markets right now where you have rate cuts associated with inflation coming down and a weakening economy, but it's not priced into equities. You know, that'll be an interesting thing we'll have to deal with. What we do in our inflation, you know, in our infrastructure practice and the other practice across the firm is very simple, which is we sort of just assume the most conservative set of facts that we can. So if it's inflation sensitive in a way that it's positive, like an infrastructure asset, okay, then let's put in 2% inflation. If it's an asset that maybe is harmed by inflation, let's assume higher inflation and see if the deal survives. It's sort of the most cowardly way of approaching investing, but I think it's the only thing you could do right now in the face of that uncertainty is we won't act unless it's sort of the more conservative frame of kind of what's going on. And then if you looked across the whole firm, it's exactly as John said. So things like credit is more appealing than it was in the past, just because you had a regime change in interest rates, so people are more interested in that. Infrastructure, I think, is probably got more demand than I've seen in my lifetime. And I spent most of my career actually as an infrastructure investor. And even before I became kind of CEO of the firm. And it's like people now realize the inflation attributes associated with infrastructure assets have a value. You know, it was one of those things you talked about it in a low inflation environment and people thought it was interesting. And it was one of those characteristics that sounded nice and protective, but they've actually have this first experience in a long time where it came to their benefit. You looked, and Robbie will go through this, but you look at our returns during this period of time, they've been exceptional. You know, it did exactly what it was supposed to do economically. And I think that's made the asset class, it sort of was a test for the asset class, and then it passed that test and people are interested in it, you know, kind of again would be the other thing that I would say. But you know, our own kind of like broad house view is that there's a lot of uncertainty and you just need to be conservative in the way that you underwrite. And that's the only way that you can move forward in the face of these things. Like John said, we don't know if there's a recession coming next year. I get asked all the time, are we going to have a recession? I'd be like, I don't know. You know, I have no idea. We're running a $2.5 trillion deficit in the United States. It's pretty hard to have a recession when you run a $2.5 trillion deficit, right? So it's sort of like fiscal and monetary policy are at odds, and it's making you get this middling outcome. And I don't know where that will land in terms of the true economic statistics, but you know, we're being conservative in the way that we're engaging with the markets, kind of as a result of all those things. And it's been an interesting period between COVID and the regime change in interest rates and inflation, and then where we are right now. And I think we're just going to keep doing what we're doing, like John said, kind of through that period. So I'm happy to take any questions on particular areas. I think what John said was right. I just try to give you a little bit of data to put context around it, and then we can kind of roll into maybe Ravi, you could spend a little bit of time talking about the portfolio and how it's really impacting what we're doing. But if maybe Andrew or anyone else had any questions, I'm happy to take them before we move on.
I can't see any hands up at this stage, Fred, so I think we're probably happy to jump straight in with Ravi and looking at detail in the portfolio, please.
All right. And are we going to let John go at this point? I just want to make sure I give him a chance to. I know John had a kind of half the session. If it made sense to you, John, I'm going to stay on.
Great. Thank you all. And we'll look forward to seeing you again soon. Thanks.
Appreciate seeing you, John. Thank you.
Yeah. Thanks, Andrew.
All right, Ravi, you had the longest preamble ever. Now you get to hit the real substance.
That's great. No, this is good. And this is actually the perfect slide. Good afternoon, everyone. Good to see everyone again. What I thought I'll do in the remaining time is I'll give you a sense of the portfolio and what's in the portfolio and how it's positioned, but then also touch upon some of the market factors a little bit and how it's affecting or expected to affect the portfolio specifically. We heard from John and Fred about the overall macro market, but how do some of these things affect the portfolio will hopefully be something that's interesting, and we can go through that. And then, of course, we leave time at the end for any kind of questions. So to take a step back, the portfolio, we started investing this portfolio in 2016, and the total fund size is 1.255 billion pounds. There's been a good amount of progress that's been made in terms of deployment of this portfolio, and you'll see that this is a snapshot. This slide is a snapshot of the progress that we have made since last year, so exactly year over year. And some of the things that jump at me from this page. One is you'll see that the level of deployment is tapering, in that we've committed roughly about 100 million or so in the last year, and the level of commitment was a lot more in the previous years. However, the contribution to investments has gone up quite significantly. And so you'll see that last year we were roughly about 600 million funded, and this year we're roughly about 800 million funded. So 100 million more of commitments, but 200 million more of deployment. And this is a good thing because this is capital being deployed in an environment like this one, where there are some pretty attractive investment opportunities, and I'll walk you through some of those opportunities as we go through the portfolio. But that capital is being invested right now in what we think is a pretty attractive time. What the impact that has is that you see the net TVPI, and what that metric means is basically just the multiple of invested capital. That has gone from a 1.39 to 1.3. And the simple reasoning for that is more capital is being deployed at cost, which brings down the multiple for a temporary period. Having said that, the portfolio has come together very nicely. We're roughly about 90% committed out of the total fund size, and we expect that the remaining capital will likely get committed in 2024. We had set out investing this portfolio with a target return of roughly around a 10% net IRR and roughly a 3 to 5% cash yield. And we're happy to report that the portfolio is outperforming that target, both on an IRR basis and then is within the range of cash yield. And there's a cash yield slide later that we will walk through. So let me pause it. I think there's a question.
Councillor Davis?
You're on mute,
Councillor Davis. We can't hear you, Councillor Davies. I think you're on mute.
You're right, I was. Right, IRR, I understand, internal rate of return. TVPI and DPI, what are these?
Sure, yeah. So TVPI stands for total value to paid in capital. And I think it's just a fancy way of saying multiple of invested cost. So, if you put in £100, the value is £130. Total
Okay.
value. And DPI is dividends to paid in capital. And what that is just dividend income coming out of the portfolio.
Okay, fine, thank you.
Yep. Councillor Kempke?
Right, you answered. That was going to be my question.
Okay, lovely. Yeah, I think we can probably do a better job of not using some of this jargon next time. Great. Well, Florence, if we can maybe move on to the next slide, slide 7. So slide 7, this is a new slide that we have added to this update. And what we wanted to do is, now that the portfolio is 90% committed, we wanted to show you a snapshot, almost like a report card of how the portfolio looks. You'll see on the left-hand side is the objectives that we had laid out in terms of portfolio construction. And the right-hand side, the pictures, show you the results as to how the portfolio has been committed. And I think one of the key objectives of the portfolio, which we're happy to have achieved, is diversification. And so the vintage year column shows the diversification and how we've been committing this portfolio over several years. And then we have diversification by sector, by geography, by risk profile, and by investment type. What's important to note here is a couple of things. One is the sector is really a nimble area where we're committing the portfolio based on what we think are the current opportunities in the market. This is a picture based on committed capital. And again, not to get too technical, but how the capital is committed. What will happen over the coming years is you're going to see a picture that's going to be more based on the value of those investments. And when you see the picture based on value, you're going to see some of these pie charts move around based on, obviously valuation changes. And the second thing I'll mention, and then I'll address the question, is that the portfolio is intentionally positioned where we have roughly 2/3 of the portfolio in core plus investments. And what that means in infrastructure terms is they're relatively safe, steady, boring investments that are meant to have long-term downside protection and long-term inflation protection. And then 1/3 of the portfolio is in investments that will create some alpha in terms of having some growth characteristics or having some expansion characteristics to be able to get the alpha generation in the Hampshire infrastructure portfolio. So I think there are a couple of questions which I can answer.
Sorry, Councillor Crawford, I was interested to see the target geography and how that squares up with the actual geography. How do you decide between the different areas in terms of priorities? I mean, at the moment, the UK seems to think it's in a good place for people to be investing, but I don't know how that compares, for example, with Europe or the rest of the world.
Right, Councillor Crawford. Unlike equity markets or public debt markets, as John mentioned upfront, infrastructure is a very long-term asset class. And this program is an evergreen long-term program. And so as we think about geography and as we think about exposure, one, this portfolio is built to mainly be exposed to stable geographies. We're not taking any emerging markets risk. We're not taking any kind of undue risk to be able to get an extra return. So that's one. All of the 100% of this is stable geographies with stable geopolitical environments and stable policy making. Two is the way we set out to construct the geographic diversification is really to be able to provide the portfolio with diversification by policy, by interest rates, by currency, and then by the infrastructure tailwinds that each of these countries have. So we don't necessarily take a view, Councillor, on whether the UK today is an interesting place to be investing in, or Europe is better, or North America is better. What we're thinking is, how are these economies going to support policy and support infrastructure build out and infrastructure contracts over the next 10, 20-year period. And so that's how we went about creating this portfolio diversification.
Okay, thank you.
Hello,
Well,
my question, Councillor Smythe, is about the sectors. How do the actual investments under these headings, particularly energy production, transportation, and potentially social, chime in with our overall pretty strong commitment to contributing to zero carbon?
Absolutely. I always think the sector pie charts are a bit unfair, because it tries to capture a bit too much into that one chart, right? Infrastructure in itself is a very big word. And then within that, there are all of these different subsectors. Telecommunications, for example. Telecommunications is encompassing a lot of different opportunities: mobile towers, data centers, fiber infrastructure, small cells. Energy production, similarly, is a very, very wide framework where there's renewables, there's conventional, there's smart metering, there's battery storage. There's a lot of different things that are encompassing energy production. The same thing with transportation, the same thing with social. One of the things you'll see when we go to the portfolio is, again, a new thing to be able to show you what's happening in the portfolio, is we have actually worked with Andrew and team to identify a framework of what we call impact investments. And the impact investments are not restricted to any one particular sector. It actually pervades the entire portfolio. And everything that we do, there's a very strong focus on impact investing. So for example, transportation. Electrification of transportation is an impact investment. Telecommunications, largely an environmentally neutral sector. But again, there are companies in there that actually have net zero targets, or are sourcing sustainable fuels for the powering of data centers. Same thing with energy production, and same thing with social. So I'll walk you through some of the examples. What we've also done, to one of the earlier questions, is for the first time in the portfolio, or in the book, we've included examples of impact that this portfolio is making. So actually, if you go to the back of the presentation, you'll see specific case studies of investments that have been made in this portfolio that are making a strong environmental and social impact. Does that answer the question?
You haven't quite. That's very interesting. No, not quite. That was very useful and very interesting. But how are we having more or less impact on reducing carbon in the atmosphere than we were last year, for example, through this fund?
Absolutely. So let me give you a couple of examples. One of the investments in this portfolio is an investment called Porterbrook. Porterbrook is one of the largest rail lessors in the UK, where it leases out freight and passenger cars to the train operating companies. Porterbrook is one of the first rail companies that has come out with a net zero ambition, where they want to become net zero on their scope 1 and scope 2 emissions by 2050. But even by 2030, reduce the scope 1 and scope 2 emissions by more than 50%. What Porterbrook has also done as a company is actually has invested in more sustainable rail cars, and actually has introduced the first hydrogen-powered train in the UK. And as you can imagine, this is something it's a big area of improvement. And this is just one example of environmental impact that this portfolio is making. There's obviously a number of investments. Sorry. There's obviously a number of investments. Yeah. Sorry, go ahead.
Well, I mean, that's very interesting and useful, but it could be a tiny, tiny investment part of this, or it could be a very big one. Are we generally having more impact on reducing carbon than we did last year through these different sectors? And I'm particularly concerned about energy production. How we haven't done as a lot of the rest of the world seem to have done, and gone back to more investment in petrochemical, in coal, oil and gas.
Yes, no, this portfolio absolutely has had more of an environmental impact compared to last year, has a lesser carbon emissions compared to last year, because investing in sustainable infrastructure is table stakes, and everything that we do, whether it's fund managers or assets, it's a big part of our focus. And so this portfolio is not exposed to coal-fired power. This portfolio is not exposed to oil and gas. This portfolio is not exposed to fossil fuel removal from the ground. It's actually positioned to continue to reduce carbon emissions. So the answer is yes.
Thank you very much. Thank you. Thank you.
If I could chip in now, Ravi, it's Councillor Joy. I just want a sort of slightly greater understanding of the geography side of things. The sort of the target bands are pretty wide bands. So, for example, North America, 20 to 50% or so. What do you actually use as a guide to deciding what is appropriate, and to what extent, perhaps on a macro basis, guides your focus on research?
Sure. Yeah. So the bands that we had set out are intentionally broad, because roughly 2/3 of this portfolio is investing in funds. And so if you take a step back and think about the portfolio, we are committing to funds which have a stated investment objective, whether it's sectors or whether it's geography. But what they actually invest in is obviously yet to be determined. And so we have broad bands, because when we invest in these funds, they then go and invest in portfolios, and the makeup of that portfolio could change based on the investment opportunity that we're seeing. We're trying not to be too prescriptive with the funds. And so you'll see that the actual picture of geography is what's on the right-hand side. So today, as we think about exposure to investments, 33% is in North America, 30% is in Europe, ex-UK, 21% is in the UK, and so on and so forth. That's the actual picture compared to what we had set out to do. In terms of our research and how we think about exposure to geographies, one of the interesting things about infrastructure is when we invest in infrastructure assets, we are very focused on the underlying regulation and the underlying contracts. And that's very important. Infrastructure, by definition, is meant to be GDP uncorrelated and is meant to be downside protected. So we're not trying to take views on what's going to be the GDP growth in the UK versus the GDP growth in the US versus Canada versus Spain or France, because these assets are not meant to be GDP correlated. Having said that, we of course have a view on different regions and where it's attractive, but we're not investing in public equities. We're not investing in publicly traded debt. So short-term movements in these economies should not have an impact on the portfolio. And I think this is what Fred was saying earlier, that even in a difficult environment like this portfolio has stood up very nicely, exactly because we've invested in safe, long-term, inflation-linked infrastructure assets.
Okay, that's fine. I mean, I'm used to the concept of a target actually having the high-scoring bit in the middle of the target, the bullseye, whereas in fact yours is basically a pretty large dartboard, if I could put it that way.
Well, again, I think the point of this portfolio is when we are done investing in funds and in the assets, you'll actually have a pretty accurate picture of the portfolio construction on the geography, and you'll see that it's very much in the center of those ranges.
Thanks very much.
Yep.
A question from Councillor Davies.
Yeah.
And Councillor Crawford, and then members. If I could just maybe say after these two questions, if we try and give Ravi, say, a good 10 minutes to try and get through some of the slides he's prepared, and then see what questions are left at the end.
Now, you say that you could actually invest up to 40% in social things, which, social sounds what I used to describe in the days when I worked in the industry as a warm fuzzy. What actually is that? Is that hospitals, schools, that sort of thing?
Yes, social infrastructure is anything that is meant for the upkeep of the economy. And so what that means is waste management, what that means is hospitals and schools under public-private partnership contracts, things like housing or any kind of security infrastructure. It's a very small part of the portfolio. I know that the target sectors have an up to 40% for everything, again, for the reasons that I just mentioned. Social infrastructure, we think, is going to land up being roughly about 15% of this portfolio, which is exactly where we want it to be.
Okay, thank you.
Yep.
So,
Councillor Crawford.
I suppose my question was allied to that, where in terms of social infrastructure, it seems that certainly in the UK, there's a lot of difficulties over getting investment in leisure centres and so on because of their huge cost of upkeep and their reliance on local government investment, which is suffering from the government cuts to local council spending and so on. Is that an area where you would sort of look to invest in the future, or is it something that you feel you would pull out of because of these difficulties?
Sure. As far as leisure centers are concerned, or even healthcare centers, or even social housing, what makes these sectors an infrastructure investment for us is the contractual framework around it, right? So if there is, say, a portfolio that actually has long-term availability-based contracts with the local councils or with the local governments that provide inflation-linked payments over a long period of time, that makes it an attractive infrastructure investment, and that's something that we would certainly consider. However, if there aren't long-term contracts with the government or with the local councils, and these are purely usage-based centers, it's difficult to justify that into an infrastructure portfolio. So yes, we would certainly consider some of this into the portfolio if it's attached with the right kind of a long-term contract in these portfolios. One of the investments actually in the portfolio, in a lot of the details, is an investment called Place First. And what Place First is an investment in a company that builds social housing across the UK. It's headquartered in Manchester, and then it builds social housing across the UK. And what this company does is, in partnership with local councils, determines the need for social housing and then builds out the social housing under long-term contracts with these councils. So that's an example of a sector, a social sector, actually then becoming an infrastructure investment because of the contracts associated with it.
Okay, is that something that Hampshire could ask you to look at?
Absolutely. Well, yes. We have a regular dialogue with Andrew and his team, and so absolutely, to the extent there are opportunities that you would like us to take a look at, please send it over, and we'd be happy to give it feedback or consider it.
Okay, thank you very much. Thank you.
Great. Any more questions before we just jump into a couple of case studies? Great.
I think so, Ravi, so keep going.
All right, great. Thanks, Andrew. Florence, if we can move to the next slide, I'll just quickly touch upon just one key point here. As we said, this portfolio is focused on investing in primary funds, secondary funds, and co-investments. I would say the key takeaway from the slide is actually the returns for each of the specific legs of the stool. And you'll see that this is very much in line with what we would expect, where co-investments are shorter hold, have current cash yield coming out of the portfolio, and so generally tend to return the highest in terms of IRR in the near term. And then primary funds is at the opposite end of the spectrum, where they are still in their investment period, they are longer in terms of hold periods, and so we expect that to be at the lower end of the IRR range. And of course, the diversification that we have across the three areas of the portfolio is what leads into the 11.4% net IRR for the Hampshire portfolio. Next slide, please. So next couple of slides are a lot of detail, and I just wanted to pause and just explain what we're trying to show here. Obviously, it's a portfolio broken up by the funds, secondaries, and co-investments across this slide and the next slide. But a couple of things that we have done to visually help readers look at this is on the right-hand side, we have added these colors for current status. And of course, green means, the portfolio is in line or ahead of expectations. Yellow means it's, slightly behind expectations, and then red is underperforming. And I think we're happy to report across this slide and the next slide that you're going to see an overwhelming majority in green, which means the portfolio is actually doing well, in line with expectations or ahead of expectations. The second thing we have done is we have colored some of the investments as blue. You'll see this on this slide and the next slide, which denote realized investments, where investments have actually been sold and cash has been returned. And as the portfolio matures, you will see a lot more blue onto this portfolio as capital comes back and then we reinvest it. This is very evident on the next slide, where you'll see a lot more cash has been returned on the co-investment side of the portfolio, exactly because of what I mentioned, which is co-investments tend to have a shorter hold period and more capital is coming back. The third thing we have done is we have added this green triangle next to the investments. And this goes back to one of the earlier questions, which is what is the impact the portfolio is making? And while this may not be an entirely accurate picture, what we have done is we have classified investments as impact investments when they are classified as Article 8 or Article 9 by the SFDR environmental classification. And so the investments that are showing a green triangle are the impact investments according to that definition. Again, as you see this portfolio mature and as you see newer investments in the portfolio, you're going to see more and more green triangles, because this is a big part of our focus, not just for Hampshire, but across our infrastructure portfolio. And the last thing I'll mention is the color gray, which I know there's a lot of detail, but the color gray is meant to show you new investments in the last 1 year. And so it just shows the level of deployment in the portfolio. Florence, next slide, please. So the one thing I wanted to mention out here is if you look at the total commitments are roughly 1.1 billion that have been made so far. This was a cutoff as of Q3 2023, so as of 30th September. And even since then, we have gotten 5 new investments approved and are in various stages of legal documentation. And so by the end of the year, this number will be closer to roughly 1.16 billion in terms of commitments out of a portfolio of 1.25 billion. So as I mentioned, we're roughly about 90% committed, and by the end of 2024, we will be fully committed in the portfolio. So let me pause there and see if there are any questions on the portfolio itself. Councillor Crawford?
Yeah, sure. You supplied an Appendix 1, which was concerned with the first project was Project Antelope, concerned with Ancala. And when I looked on the table, it seemed that the Ancala funds there didn't include the Ancala Fund 1, which is what you were saying we should be investing in more. So I don't, why was Ancala Fund 1 not on the table?
Sure, yeah. So the fund that you're mentioning is actually on this slide. If you look at the Ancala Essential Growth Infrastructure Fund. So that's the last secondary commitment towards the bottom of that table. That is the fund that's now invested in the portfolio. To give you some background there, Councillor Crawford, Ancala is a mid-market European infrastructure manager that has their flagship funds, and we have invested in these funds on behalf of the portfolio. At the beginning of this year, they actually had a continuation fund that they had set up called the Ancala Essential Growth Infrastructure Fund. And what that fund did is took 3 of their existing assets in UK infrastructure, and for various reasons of additional growth that was expected in those 3 investments, they put it into a continuation vehicle, and we were able to come in and invest in those 3 assets at the net asset value that they had set for that fund. And so that's the investment you're seeing on the secondary commitment side.
So is it expected that will perform better than the other Ancala funds that you have in the table? Because it doesn't have a green triangle, which is what we would hope for, I suppose.
Yes. So Ancala Essential Growth Infrastructure Fund is not classified as a green triangle so far, only because they've applied for an SFDR classification. We expect that by June of 2024, it will be classified as Article 8, Article 9, and then it will have a green triangle once they get that classification approved. In terms of your other question on do we expect this to perform better than the other funds, I would probably position it slightly differently in that unlike other Oncala infrastructure funds, where it's a blind pool, right? We're investing in the manager and then they're going to go and invest in assets. In this particular fund, we knew 100% of what the assets are going to be. There were 3 specific assets. So we had specific return expectations and underwriting expectations for these 3 assets. And so from a total return perspective, yes, Oncala Essential Growth Infrastructure Fund is expected to yield a higher return just because we know what the assets are. Having said that, the other Oncala funds are not yet fully invested. They are still investing. So there is certainly room for outperformance once that's done.
Okay, thanks very much. Thank you.
Yeah. On the next slide, we just wanted to visually show the cash yield. And again, as I mentioned, we had set out this portfolio with roughly a 10% net IRR target and then a 3 to 5% cash yield. The inception to date cash yield is about 3.14%. But again, as we have invested a large part of the portfolio for the last 2 to 3 years, we expect this cash yield to continue to tick up over the coming years as the portfolio becomes more mature. What's also important to note in our cash yield calculation is that we do not include realizations of investments. This is purely dividends or interest income that comes out of the portfolio, and that's what you're seeing on this slide. And then lastly, I just wanted to mention, I know we're coming up on time, I just wanted to mention, if we go to slide 17 onwards, this is our ESG and impact overview, and this is something that we have spoken to you multiple times about how we are involved in the ESG frameworks across the industry and how we incorporate it in our diligence. But one of the things we did want to do is specifically point out some of the case studies of investments that are in the portfolio and what kind of environmental and social impacts that these case studies are making. And this is something that we intend to include going forward in our presentations as a way to be able to show you the impact that the portfolio is making. So I don't intend to run through these slides, and I think it makes for good reading for anyone who's interested in the portfolio. I already touched upon Porter Brook as one of the investments, which is part of the case studies out here. But with that, maybe we can pause and open it up for any questions on the portfolio, on the economy, on GCM Grosvenor, or anything else. Unless Lawrence, I missed something that we need to cover. Great. We have one question.
Councillor Drew.
Yes, thank you very much. You just reminded me by putting that slide up about climate infrastructure fund. You've had a lot of questions, or a number of questions, about CO2 emissions and CO2 reductions and the need to do that. Completely agree. However, would it not make more sense generally, and I'm not quite sure how you apply this to funds, to ensure that there is an element of adaptation and mitigation in what investments in the investments that we are making, because I think that would be a more rounded approach. I mean, I say to people that if Britain stopped emitting CO2 tomorrow, the planet would still be warming up at an overly alarming rate, and consequently, and I'm sure we won't. We'll be staying strong, but I think that we need to have that sort of rounded and balanced approach, so that we are taking action to ensure citizens that suffer at the least from the changes that are inevitable, while tackling the actual changes themselves.
Sure. Yeah, absolutely. One of the issues around environmental impact, as far as the alternatives industry is concerned, is the lack of standardization. And no matter what we discuss today, this is an ever-changing scenario where different alternatives firms, not just infrastructure, across the entire space, people are adapting to reporting standards, and people are adapting to how they want to report impact from the portfolio. So I wish we could sit here and say we had 1 or 2 or 3 pretty metrics across the entire portfolio of like carbon emissions saved or gallons of water saved or mitigated. Unfortunately, the reporting is not yet standardized and available, which is why we dig through these portfolios and the reports to bring you some of this detail on the portfolio investment by investment. Having said that, the one thing we can standardize, to answer your question, is our diligence on these investments. And so when we look at fund managers and when we look at assets, we can certainly conduct a detailed diligence on their ESG policies, on how they go about implementing this with the underlying portfolio companies, what kind of net zero ambitions they have for the portfolio companies. Are there specific people in their team that are focused on just carbon emissions or ESG and implementing that across the portfolio companies? And that's something that we certainly do across all of our investments, and that's a standardized approach. And that's why there's no surprise that you're seeing some pretty good examples in this portfolio of environmental and social impact.
Great. No, thank you very much. Thank you.
Yep.
Councillor Davies.
Thank you. A comment made earlier today by Councillor Kemp G was that the essence of good fund management is to run your profits and cut your losses. Now, if we go back a couple of slides, then you'll see that you have one there. Now, there are a number of investments there which have negative internal rates of return, and they have, TVIs which are poor, very poor. Why are we still holding those, or why are you still holding those?
Sure, yeah, and this is something I should have mentioned when I went through the portfolio. I think I try and do that. Other than the one investment that's marked as red, none of these investments are underperforming. They are just in different stages of their life cycle. So say, for example, let's take, for example, Place First, right, which is held at a 1.02x MOIC and a 2.6% IRR. This is still a very young investment. We have just made the investment in 2022, and this is one that's going to continue to build out that social housing. That's going to then accrete in value. Similarly, if you take a look at something like Open Fiber, which we have marked as yellow, this is an investment in laying out fiber in a highly underpenetrated area. And as you can imagine, when fiber is laid out, by the time it starts generating revenue and actually starts generating profit, that value accretion is going to happen over the next 3 to 5 years. So all of these investments, other than the one that's marked as red, are healthy investments, are expected to perform in line with expectations. And that's why we have that column on the right-hand side, which was the green, yellow, and the red. So at this point, what we are focused on is monitoring these investments and making sure that the value creation happens in line with expectations. We're not focused on selling any of these because we don't think any of these are underperforming.
Okay.
So, is it my turn now?
Yep.
Okay, thanks very much. I wanted to ask about Appendix 2, the GCM engagement. A couple of questions there. The first item, in terms of investment rationale, in our responsible investment policy, we had a review last year and committed to exiting investment in coal, and yet this company has been given until 2030 to exit from coal. So that's a question. How do you manage what's in our responsible investment policy compared to what you're saying in your example? And the other question is on the next company. Again, it's in investment rationale. The question here is, it may be that the electricity transmission is ESG compliant, but if they're using electricity that's generated by coal, for example, that would mean that the whole system is just not acceptable, because this is what's happening in China. I mean, they're going over massively to generating power by coal-fired power stations, yet they're claiming to be going green. I mean, it just doesn't work. Thanks very much. Sorry.
Sure, absolutely. Andrew, would it be possible to share what Councillor Crawford is referring to? Because I don't think we have. I want to see what specific investments he's referring to, so we can address the question, and maybe we can follow up with the answers. I just don't have the materials in front of me.
I'm not sure I do either, Ravi. In terms of Councillor Crawford, is there a particular investment in the portfolio that you've seen that you think has got a holding in coal?
Councillor Crawford, you're still on mute.
Your pardon, I try to switch off when I'm not speaking. But in Appendix 2, it's the GCM engagement examples. It's the first example.
Oh, beg your pardon. Okay.
And then so the second question was about the second example.
Okay, so these are the engagement examples you've sent us previously. So yeah, perhaps in the interest
I
of
don't
time,
mind if you want to follow up.
Yeah.
By a
Right,
written
come back
Councillor
to you
Crawford,
on that with
I
Ravi's
just want to
help.
see what the investments are, Councillor Crawford, and we can certainly come back to you. I just don't have
well,
the reference material.
Yes, okay, I'll leave Andrew to email you so that we have communication in the proper channels, if that's okay.
Sure. Great. Well, sorry, we've run over a little bit, Andrew, but is there anything else we can address or answer?
Not a problem, Ravi. I appreciate we were a little bit behind time with you guys, so you've kept to an hour wonderfully for us. So thank you for that. I don't think we've got any more questions. I can't see any more hands up from the members, so I think it just remains to say thank you and have a good afternoon, or what's left of the morning, perhaps, for Fred.
Thank you.
Okay, thanks very much.
Thanks
you
for the
so
level
much.
of engagement, and thanks for the questions. Really appreciate it.
Thank you very much. Thank you.
Thank you all. Have a good day. Thanks.
Thanks. Bye.
Thank you.